In 2008, the world watched in disbelief as Lehman Brothers collapsed, Wall Street panicked, and ordinary Americans saw their jobs, homes, and retirement savings evaporate. It was the most devastating financial crisis since the Great Depression, and yet we survived. Banks were bailed out. Governments pumped trillions into the economy, and eventually, the system recovered. But here's the uncomfortable truth. The very medicine that saved the economy back then has created an even more fragile system today. Central banks cut interest rates to zero, flooded markets with liquidity, and expanded debt like never before. Instead of curing the disease, we simply numbed the pain, while the underlying illness metastasized. Back then, the danger came from reckless banks and subprime mortgages. Today, the risks are far larger. Ballooning government debt, corporate borrowing at historic highs, household credit stretched thin, and speculative bubbles across stocks, real estate, and even digital assets. Unlike 2008, the next collapse won't be isolated to housing or banking. It will be systemic, touching every corner of the economy. What if 2008 was just the rehearsal? What if the real crisis is yet to come? That's the story we're going to uncover. Why the next financial collapse may not just repeat the pain of 2008, but surpass it in scale, severity, and consequences. The 2008 crisis taught the world a lesson, but not the one most people think. Instead of restraining debt, we unleashed it. Global debt has more than doubled since the crash, now surpassing $300 trillion. Governments borrowed to bail out banks. Companies borrowed at low rates to buy back shares. And households borrowed to maintain lifestyles as wages stagnated. In the United States, federal debt was around $9 trillion in 2008. Today, it has ballooned past $34 trillion. Corporate debt, once considered manageable, has exploded to over $13 trillion, much of it tied to junk bonds and speculative ventures. Even households, despite the scars of the mortgage crisis, are once again drowning in credit card balances, auto loans, and student debt. This matters because debt is a promise about the future. It assumes tomorrow's income will pay for today's spending. But what happens when tomorrow doesn't deliver? What happens when growth stalls, interest rates rise, or confidence evaporates? Debt turns from a tool into a trap. In 2008, the fire started in subprime mortgages. In the next crisis, the fire could start anywhere: sovereign debt, corporate bonds, or even the U.S. Treasury market itself. And this time, the flames will spread faster, because the pile of debt is far higher and far drier. In 2008, the Federal Reserve stepped in as the ultimate firefighter. By slashing interest rates to zero and launching quantitative easing, it stabilized the system. The ECB, Bank of Japan, and others followed suit. Trillions were conjured into existence with the push of a button. For a while, it seemed miraculous. Stock markets soared, home prices recovered. Investors cheered. Central bankers became modern-day wizards, able to create money out of thin air. But here's the danger. This solution has no exit strategy. After more than a decade of near-zero interest rates, the economy became addicted to cheap money. Every bubble, in tech stocks, real estate, crypto, and beyond, was inflated by this artificial environment. When inflation roared back in 2021-2022, central banks tried to fight it by raising rates. But raising rates exposed just how fragile the system had become. Suddenly, banks like Silicon Valley Bank collapsed under the weight of bond losses. Housing markets froze. Emerging economies buckled under dollar debt. The illusion of control is breaking. Central banks may still hold the matches, but the fire has grown beyond their ability to contain. In 2008, the crisis began in America, but quickly spread abroad. Today, the world is even more interconnected, and therefore more vulnerable. China carries enormous real estate debt, with developers like Evergrande already collapsing. Japan remains burdened by decades of public borrowing. Europe faces banking fragilities, energy shocks, and sovereign debt stress in countries like Italy. Emerging markets from Turkey to Argentina are drowning in dollar-denominated loans. The global financial system is a web of obligations. If one node fails, the shockwaves travel instantly. A default in China's property market can rattle Wall Street. A bond sell-off in the U.S. can bankrupt developing nations overnight. In 2008, the system was fragile but smaller. Today it's bigger, more leveraged, and more exposed. The next collapse won't respect borders. It will be a truly global crisis, amplified by the speed of modern markets and the interconnectedness of digital finance. One of the darkest realities of debt is political paralysis. In 2008, governments could still rally behind stimulus packages. Today, political systems are deeply polarized. In the US, debt ceiling battles routinely threaten default. In Europe, austerity debates pit North against South. Globally, cooperation has eroded as nations pursue self-interest. The truth is, solving debt requires sacrifice, higher taxes, spending cuts, or inflation that erodes value. But no politician wants to deliver that pain. Instead, leaders kick the can down the road, borrowing more, promising growth that never comes, and leaving the problem for the next election cycle. This paralysis makes the next crisis more dangerous. When the fire comes, there will be no consensus on how to fight it. Political gridlock could turn a financial shock into a social and geopolitical catastrophe. Financial crises aren't just numbers on screens. They are lived experiences. In 2008, millions lost jobs, homes, and retirement savings. The scars remain today. The next collapse will cut deeper because the stakes are higher. Housing costs are already unaffordable. Healthcare and education expenses weigh heavily on families. Inequality is worse than it was in 2008. Social trust is eroding. A severe downturn could trigger mass unemployment, foreclosures, bankruptcies, and even political unrest. History shows us that economic collapse often precedes social upheaval, from the Great Depression fueling extremism in the 1930s to the debt crises of Latin America sparking revolutions. If 2008 shook faith in Wall Street, the next crisis could shake faith in the system itself. The story of 2008 is not over. It was a warning shot. But instead of heeding the lesson, we built an even more fragile system. Bigger debt, larger bubbles, deeper inequality, weaker politics. The next financial collapse will be worse not because history repeats, but because history compounds. Every shortcut we took after 2008 has amplified the risks. The lesson is simple but sobering. Debt-driven prosperity is temporary. You cannot borrow indefinitely without consequence. When trust breaks, in governments, banks, or currencies, collapse follows. This isn't fear-mongering. It's history. From Rome's debased denarius to Britain's imperial debt to 2008, the pattern is clear. Empires fall not when they run out of power, but when they run out of financial credibility. The question isn't if another collapse will come. It's when, and when it does, the shock will be global, deeper, and more transformative than anything we've seen in our lifetimes.